Hello and welcome to episode 275 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Damien, here we are, we're back again. How are you doing?
I'm very good, Andy. Another week, another podcast. Hopefully, we're getting nearer and nearer the point where you and I can be reunited in the office rather than doing this over distant phone calls and internet.
I have missed doing it face to face, but I have to say, Damien, the podcast is absolutely smashing all records at the moment. So maybe we've stumbled upon the perfect way to do it. I don't know. Last week's stats, I was having a little look earlier and through the roof. So thanks everyone that downloaded it. If anyone's been sharing it, it's been brilliant. We're really seeing the fruits of what we're doing. Obviously, the reviews are helping as well.
Yeah, so do leave a review. I'll mention that at the beginning of the podcast on whatever service that you use, whatever podcast app, because it does really help and spread the word. Because as Andy said, it was our best ever week or day for downloads. I think it was the last week. So that was incredible. If you follow us on social media, then you would have seen us celebrate that fact. And in fact, we actually crossed another milestone of 1,500 YouTube subscribers, which was nice. We're shortly going to be crossing a milestone of nearly 2,000 members of our Facebook community. So we're seeing a wave of you join the Facebook community. So please make sure you join the Facebook community because you get a lot from it. There's lots of people asking questions, for example, this week regarding savings. Marcus, the savings entity from Goldman Sachs, close their market leading easy access account. So that was another option that's been scratched for savers. So rates are seemingly on the downward trend if you want to get some money on your savings. So we were talking about that in the group and alternatives. So there's a lot of stuff that goes on when people share. And actually, I mentioned one thing. In the group, there tends to often be a follow-up discussion to some of the stuff that happens on the podcast. And last week, a few of you picked up on the last piece of the podcast, which was only about a minute long, when I was talking about refunds on deposits that people had paid on when they were renting. There was a caveat I should have added on that, which was basically the refund applied to people who were renewing their contracts, or they went from a periodic tenancy to a fixed term tenancy. So I just wanted to quickly mention that, just in case anybody hadn't listened to the amended version that went out very quickly after the original. So if you haven't, then now you know. So anyway, Andy, on to this week's show.
Yep. So what do we got on this week's show then?
Okay, there is an investment piece and a piece regarding financial advice and pensions. So I want to talk about candlesticks. And for a lot of people out there, they might wonder where this is going. Some of you might have heard of candlesticks, but it's a type of charting. Now, this is going to either work brilliantly or fall flat. I'm hoping for the former of brilliantly, because there's going to be a slight interaction element to this, because we're going to put some imagery on the post online so that people can look at it, because they need to see what I'm talking about. So I'm going to do a little bit about candlesticks. It's very relevant to the market at the moment. And the second piece is regarding financial advice on final salary pension transfers. And the FCA, which is the regulator, came out and banned contingent charging. So I want to explain what that means, but more importantly, I want to run through a bit of a checklist for people who may have already had advice, or they may know somebody who's had advice. And it's a checklist to listen to, and you may work out that you might have had poor advice in regarding transferring your final salary pension, and you may have grounds for a complaint. And the final piece, I'm going to hand over to you, Andy.
Yeah, so hot on the heels of a piece we did a couple of weeks ago about children and money. And in recognition of the fact that it's My Money Week this week, I'm just going to do a short piece on apps that are out there that can help you and your children with their pocket money and being able to spend that pocket money without having to handle physical cash. We've talked about physical cash before. It's good for children because it gives them the element of being able to feel money and count it. But actually, in the current environment, we're kind of being pushed away from cash and doing contactless. So it's a piece covering that. Right. So what are we going to start with this week?
Candlesticks, Andy. So for most people, they will have seen a chart, like a line chart of the stock market. So if you were going to get your iPhone phone out to your pocket, look at the stock market app that's on there, click on it, look at the FTSE 100 or whatever stock that appears or whatever index that appears on there, and you will see there's a wiggly line going up and down. And you'll also see that that wiggly line goes up and down during each given day. And that's the ups and downs of the stock price or the index in question, like the FTSE 100. Now, obviously, when you look at that, there's a lot of movement going on. There's a lot of information to take on board. And when you analyze the movements of the market, you can sometimes perhaps get a bit more information as where the market could potentially head, like the possible futures. On previous podcasts, I've talked about lines of support and resistance on stock markets. And that, in very simple terms, a line of support is an imaginary line that the stock price or index seems to bounce up from. So it acts as a support level. So when the market pushes down towards it, it then rebounds off it. If it breaks down below that, that's a negative sign. A line of resistance is where you push up and it's like a glass ceiling that's there, and the market therefore can't get enough momentum to get through it and then pulls back. To give some context, on the FTSE 100, if you look at your app at the moment, 6,000 is a support level. And on the S&P 500, there is one around 3,000. There was one around 3,100. If you listen to Midweek Markets, I talk about them quite often. And it's a very simple way of just looking at technical analysis. This all falls under that technical analysis umbrella. So you look at the possible outcomes by looking at these lines of support. So if a line of support breaks, it's a bad sign. It can mean the market goes down to the next line of support. So they're always lines of support on the way down. They turn into lines of resistance when they're broken. Think of it like a weather forecast. It's not set in stone. It isn't a guarantee of a future event or where the market will go. But if given a certain setup, it can make certain outcomes much more likely. So like a weather forecast when you're on telly, the weather man or woman tells you that it's going to rain or you have a shower. It's not guaranteed it's going to rain where you are. And in fact, you might take an umbrella to work and wish you hadn't, or vice versa, even worse. You didn't take an umbrella and you get wet. Now, they are quite useful for giving people a steer where markets might end up. We don't want to obsess about them, but I want to take it a step further. The concept of candlesticks. Now, if you look at any technical analysis chart that's out there or article, you will start to see these strange green and red blocks that appear on the chart. So rather than a wiggly line, each day is represented by what is called a candle. And the reason it's called a candle is because it looks like one. So you get a square body, like the wax part of a candle, and you get a little line above, which is like a wick, and you get a line below. Now, pause the podcast, go to the Money to the Masses website, and you will find on the podcast menu. So if you go to the top of the site, there will be a link to podcasts. If you click on that, you see every podcast that we ever do. We put a post on the Money to the Masses website, and the links that we talk about, you can find them in those particular shows articles. I hadn't actually realised this, Andy. I was looking the other day. When we talk about the show notes on podcasts, often the links don't pull through on iTunes, on the podcast apps, for example. So if you find your app doesn't provide a clickable link, do go to the Money to the Masses website. You will find an article under that section for every podcast we do, whether it's Midweek Markets or the Sunday podcast, and you'll find links that you can click on. In this week's article, there will be some pictures you can look at. So we're going to show you what one of these candles looks like, and we're going to show you what a group of them together looks like. So if you go and look at that image now, you will see a typical looking candle. So there's this main body, which is like the wax part of a candle, and then there's a shadow above and usually below. So line above, which looks like a wick, and a bit below. So what that does is it gives you a representation of what went on in this stock market that particular day, or whatever time frame you're using. We'll talk about it as a daily basis to help people visualize. So the body of the candle, what it does, the lower part of it shows where the market closed or opened. The top part is the opposite in reverse. So you will see that on that chart I put there's a red and there's a green version of the candle. And on a red candle, that shows you that the market fell that day. And what you do is you look at that candle and it says the top part of the main body, that's where the market opened. The bottom part of that candle is where it closed, and that bit in between is coloured red. You do get the candles not in red, you get them white and black, but we're going to talk about green and red. The shadows, the sort of wick parts, show you the range of the market move in that day. So the highs where the line goes up, and the line going down below the body, if there is one, then that's the lowest point of where the market went. And it's a very good way of giving a visual representation of what went on in that day without all the intricate wiggly lines. It gives you a sense of that the market opened at this point, it rallied up to this high, maybe dropped down to this level, and then closed up. It's a very good pictorial summary of what went on. It cuts out the noise. And the reason I mention that is because, like the weather map analogy, when we just look at a wiggly line chart and maybe put some lines of support and resistance, which anybody can do, you can see them. Go back and listen to a previous podcast where I've described how you do it. This gives you the bit more detail. So it's a bit like having a weather map with the weather fronts on it. You remember when you used to see that? But you used to do it years ago, if I remember, when you looked at weather maps. They used to give you the cold front and the warm front. And I'm sure it's an occluded front is when they merge. But of course, that means those different symbols give you more information, and perhaps for a meteorologist, they can determine the possible weather that will happen around those fronts and going forward. So what this is the equivalent of that. It gives you a bit more information, but it gives you it visually. And what you can do is, I described a candle on a daily basis. And if you look at that picture, you can see the two options, one where the market closed down, the one where the market closed up. Now, what happens is, depending on what happened in that day, that shape can look very different. And you'll see a second chart that gives you lots of different examples and shapes of what a candle can ultimately look like. So go and have a look at them. What this is the equivalent of is that when you go bird spotting, I know people might laugh. I used to be a bit of a twitcher when I was younger. My dad used to take me and I loved it. And maybe most people don't go bird watching, but you see birds out there and you don't know what they are. And the only way you find out is by looking them up in a book. This is kind of that sheet that you look at them, and these are the sort of different species of those candles describing of the movements in a given day. Now, those particular candles have particular characteristics and suggest that the market might be doing something. So it might be a suggestion that the bulls are getting more dominant in the market and taking control over the bears, and that the market might start to push higher. And what I want people to start to look at is, there's a link in there. I'm going to put a link, and the link will take you directly through to a chart of the American stock market, the S&P 500. It's going to be live, and it will show you the daily candles over the last 6 months. Every day is going to have a candle, and notice all the different shapes and sizes of those candles. And the reason it's really good and a great time to do this now is because when you get a market where there's a lot going on, you see some really exciting stuff. It's a bit like if you went into a, keeping the bird watching analogy, you went into the woods and then off a massive bang, then all the birds would fly up and you see a lot of things in one go. And that's kind of what's happened with the stock market crash and the coronavirus. So it's really getting people to go and look and say, oh, I wonder what those coloured charts were. Or if they hadn't seen them before, go, oh, this is interesting, because this is the stuff that the traders use, the institutions use. They watch this stuff avidly, and it does start to determine the information they have and where they think markets go. So you look at that chart that I've got there, that you clicked on the link that shows you the daily candles going back for like the last 6 months. You'll see a whole mixture. Look at around the point when the markets crashed. Look at the big red ones you saw. Now, what's interesting about these candles is that it's not just about them on their own. On their own, they give you a bit of information about what went on in a given day. But what gets quite interesting is when you start getting groups of them together behaving in certain ways. So the relationship between them, that can start to tell you something a bit more about what is driving the market and what might go on in the coming days. Now, it isn't guaranteed, and some of these things start to unfold, these bearish signals. So you might get a whole series of candles start to formulate a pattern, a recognized pattern, because there's another picture I've got to put in that article that shows you some of these three things together. So you might hear terms like a inside up, you hear terms of individual candles like a doji, these sort of bizarre names. It's like bird names. So you start to recognize them, but you start seeing groups of them together. I think there's one of them called like 3 white nights. I think there's 3 black crows is another one, where it describes 3 days where things start to look worse. So you get lots of red candles in a row. And when you get these patterns, some of them are more reliable than others. And what I want people to do is start to see if they can spot any of them. Not to try and predict the future, but start to see if they can spot on any of them. There is going to be another link in there which does all the hard work for you. And if you scroll down to the bottom of the link that I'm going to put in there, that identifies these patterns already. So there are sites out there. I've been doing this for years and talking about investing. That I found some free resources like the charts I've already shared that will do a lot of the charting for you. And some of them will identify potential shapes, potential candlestick moves out there about, and particularly what it does, it shows you where the market could potentially change direction, suddenly get a big upswing. Particularly if you look at the March lows, there were some interesting candlesticks down that point, obviously the highs in February. And the site in question starts to highlight those for you. So you don't have to be a genius at this stuff. There are people out there putting out free information for you on this candlestick formations. And the reason that this week it struck me in particular, I wanted to highlight it to people and just prick their interest a little bit, because that's what this is all about. If you can get people just a little bit interested, they start to discover and go, oh, look, I spotted that. Then they become interested in bird watching or financial markets, or just understanding maybe a little bit more about candlesticks. I don't want people going off and becoming day traders. It's not about that. It's just giving people more information about what's going on. Like if you start to understand the birds out there and you start to realize that's a goldfinch, that's a chaffinch, all these different birds, you start to become a bit more aware of the world around you and maybe a little bit more in awe and appreciative of it. Same thing with investment markets. You start to realize there's a little bit more information out there and you start to understand and appreciate perhaps why things are going on. The interesting thing with candlesticks and the technical analysis, it isn't bothered about Donald Trump. It's not bothered about the coronavirus. It's not bothered about what the US Federal Reserve says or does. It's focused purely on price. So it looks at the waves in the market, the moves in the market. It's not worried about what else is going on. It's looking at price. And when you get certain characteristics, it often suggests that you might get another particular pattern. Now, this week, you will see a really interesting pattern that occurred. As I make this, in case you're listening to this a year or two in advance, this is still very relevant. If you go back to the 10th of June, so this week, 10th of June 2020, you will see that the market was continuing rallying. It was already in an upswing from the lows of March. And we got to a point where we had some amazing jobs numbers. If you listen to midweek markets, I explained the market leapt higher. So the S&P 500 is where I'm focusing. That's the market I'm talking about here. You will see on the chart that I linked to that the market shot up higher. And in fact, it jumped so much that that little candlestick for the day of the leap was so much higher than all the others. It was almost detached, because usually what happens each day starts to open or close in quite close proximity to the previous day. But this day it leapt higher. Then you started to get two candles after that, some red candles. And this was a trading pattern they call an inside down formation. Don't worry about it. But what was more important, there was already the potential for something called an island reversal. Now, if you look at that chart, you will sit there and see, I think I get why they call it that, because it looks like this little island in the sky, all on its own, away from the main chaos of the market. Because when the market then broke down aggressively, as it did on Thursday, this island became detached on its own, and it's a bearish signal. But you could almost see that it was starting to form. And it gave you perhaps an insight or a bit of an early warning that we could see this huge sell-off as we did on Thursday. Now, of course, sometimes you get these setups and they don't actually come to fruition. Things change. So that's why it's not 100% accurate. But I wanted to get people interested in just looking at it, because I am not a technician. I don't look at candlesticks a lot. I mean, I am very much aware of them. I talk about them for 80/20 investor members, but that isn't what I do all day. But even if I can sit there and start to spot these patterns, it is interesting to see that. And it actually gives you some information about what to expect in markets going forward. And I don't want people to try and pick the tops and bottoms of markets. But one of the big questions people have is, when's the market going to stop falling, or when's it going to crash? Now, this is just perhaps breadcrumbs that they could formulate their own opinions that may be proved right or they may be proved wrong. And for longer term investors, focus on the longer term. Like I said, you can drill down. So they have candlesticks on a daily basis, weekly, monthly, but you can drill down into hourly, 15 minutes, 5-minute time frames. And they give you lots of information. And it's almost like fractals. You can keep zooming in. Obviously, as long-term investors, you'll focus more on perhaps longer-term candles, maybe monthly. And there's an interesting one I've mentioned on midweek markets, which is the 10-month moving average, something I talked about with 80/20 investor members, which is just a candle talking about the whole entire month, and then looking at that in relation to a particular moving average as maybe a sort of buy or sell signal. It just gives people a little bit more information. They may find it interesting. It may get people perhaps exploring a little bit more about it. If you want to know a bit more about this stuff, then I can suggest you read there's lots of books out there that do this stuff. But I mean, one that I have read previously is Trading Technical Analysis Masterclass. Now, it's a Kindle book. Well, you can actually buy it paperback, but on Kindle, you can get it for $1.99. So if you want something you can look at with some nice pictures in it and a good explanation, then that is one such book. I'm not saying it's the best book out there. It's got a lot of good reviews, actually. It's got almost 5 stars out of 305 ratings on Amazon. But it's just a book that you might, for $1.99, look at it and go, I wonder what that is. And then you get a little bit more interested in it, and you can take the information and use it as you wish. Now, of course, as long-term investors, or I do, in particular as a long-term investor, I don't focus on it, but it can, as I say, if you zoom out, give you a view on perhaps whether the market is going to go up or down. And yeah, okay, there could be a potential that some people might, if they're deploying cash, a big lump sum of cash, look at it and maybe use it as an indicator that, do I think the market is about to crash? The thing is, of course, you can't time the market, but you should drip in instead if you're worried about markets falling, as I've explained in the past. But it is another tool out there. And it'd be wrong of me not to tell people about them. The market is using them. There are almost a self-fulfilling prophecy in these things. If everybody's looking at it, they all start noticing the same patterns, and it starts becoming a bit of a self-fulfilling prophecy. And of course, if people are sitting there thinking they might withdraw from the markets, then again, it might be an information provider that they may inform their decision. Don't dictate it, but it might inform their decision. So hopefully you will have enjoyed that piece by having a bit of interaction, looking at the links that I talked about in that piece, going and look at the website, and just appreciating, yeah, do you know what? I now get what these candlesticks are. And if you want to go and explore it a bit more, then do go and look at the book I mentioned. Do look at YouTube. There's lots of videos out there. I would add a word of caution, because it's not a science. There is a lot of interpretation that goes on, because like anything in life, you might sit there and think this particular pattern's forming. Someone else disagrees and says another one. So at the same point in time, you can have somebody be completely bearish and someone could be completely bullish. So if you start to watch videos, you have to be careful not to just take what they say as gospel, because some people in this area can be very opinionated. But take it, run with it, enjoy it.
Damien, I'm never going to be able to look at a candlestick the same way again. I've moved into a new house and it's been fairly well decorated. My wife is a fan of candles and they're all over the house. And you've changed my life now. I won't be able to look at them the same way again. I learned a lot there.
Get some green and red candles, Andy. You could have almost a money theme going through your house.
That was brilliant. I was learning live there and actually looking at the image that you described that we put on the website there at the same time. And I say to listeners, do the same. Pause the podcast, go on to the site that Damien said, have a look at the pictures while he's describing it, because it really helped me visualize exactly what he was talking about. That was brilliant. Okay, so we're moving on to pensions, and we're going to be talking about final salary pensions and contingent charging. What is it? What's happening?
Okay, so final salary pension schemes are defined benefit pensions. Now, days gone by, they were prevalent. Now, obviously, there are a lot of people, well, most people don't have a final salary pension at all. And what's happened, the way a final salary pension scheme works, very loosely, is it was based upon service. So you might work for a company for a period of time, say you were 20 until you were 60, they'd work out your service period, which in that case was 40 years, times it by your final pensionable salary, to be a definition what that was, an amount of money, and an accrual rate, so a fraction that then would work out this would be your income in retirement, and that would be guaranteed. We have now mostly defined contribution pensions. So if you think of something like a SIP, you put money into a pot, that pot goes up and down in line with the stock market or whatever you invest in, and whatever amount of money is left by the time you retire, you've got to use that to live on. And there's no guarantees involved. So final salary pensions became very expensive for companies to run. They started to stop doing it, but they still exist for the lucky few. But what it means is there were a lot of people who have historic final salary pensions. And of course, there was a period of time where pension freedoms came in. If you remember April 2015, we had pension freedoms, and that started to allow people to do a lot more with their pensions. And it started to allow people to cash in their pensions, so they could get to retirement and say, do you know what? I want to take all my money out of a defined contribution pension. We've talked about this in the past. We're not going to dwell on it now. Of course, for people who are in final salary schemes, where they were just paid a very good income over a period of time, they felt that they would want to be able to have that benefit if they wanted to. And so it opened up this possibility of transferring a final salary scheme into a defined contribution pension. Now, I say it opened it up. What it really did, it increased the demand for people who were trying to do that. And they were able to do that. Now, there were rules put in place that if you had more than 30,000 as a transfer value, because what would happen, they'd calculate a transfer value for that final salary pension, and it would be quite a big number in some instances. And they would move that into perhaps a SIP or something like that. And it would be a very big number. You could get somebody who would suddenly have £500,000 in a pot, and they would think that was obviously incredible. The problem is that defined benefit, that final salary, was guaranteed. Now you've entered into the world of uncertainty, and there'll be people out there, and I've seen emails from people who have transferred their final salary just before the crash of February 2020, and their pot suddenly dropped by 20-30% almost overnight. And then they are panicking because therefore that would impact their retirement income. In a final salary pension, assuming that everything is going along as it should do, you are guaranteed to get the income that you were promised, and that would usually increase with inflation. I mean, they are that good. Of course, there are instances where there are people who might want to move their final salary pensions across. That's very nuanced. But on the whole, people are better off staying in a final salary pension. And the most important thing is you need to seek advice. And if you had more than £30,000 as a transfer value, you had to seek advice under the rules. But of course, what this did is it enabled financial advisors, and I'm talking about the slightly dishonest ones out there, that were clicking their heels with glee over the idea that there were people in these final salary schemes who could transfer across to a defined contribution pension, and it would be a huge sum. And what they would do is they would charge the fee for their advice on the basis that the transfer occurred. So if the person transferred their pension, then they would get paid. And of course, the amount you're talking about is like perhaps north of £10,000 for a transfer, given the size of the money involved, because they would do a percentage. Now, the FCA quite rightly started looking at this contingent charging structure, which is, like I said, is where somebody gets paid once you make the transfer. That's how they pay for the advice. They looked at it and thought there was a conflict of interest, because if you think about it, Andy, someone does a lot of work for giving advice on a potential transfer, whether you should or not. If they're only going to get paid, and they're going to get paid a very large sum based on you actually doing it, then there is a conflict there. It opens up the opportunity for people just to go wading in and start transferring people out of a defined benefit pension with the promise of saying, look how much money you're going to have over here. And don't forget, some of these were people who were working in maybe industries where they weren't necessarily that highly paid, or didn't have a pension provision that they felt was adequate. So they could be maybe miners, and then they suddenly get this huge, a few £100,000 in a pension over here, which they then have access to. That's attractive. It's an easy sell. So it isn't just a theoretical thing that happened. The FCA looked at all the transfers that were going on, and they deemed it that there was a disproportionate amount of them that went ahead that shouldn't have done. The advice wasn't good enough. So this has been going on for some time, and unfortunately, there were some well-documented instances of some advisors who were literally almost railroading whole groups of people, whole towns that were centered around certain industries where people were in these schemes to transfer. Because it's very easy to get people to do that once they hear that their mate John has suddenly got all this money that they've got access to convince them, even though it wasn't the best thing for them to do. So the FCA took a decision to review the contingent charging idea, hoping that by banning it, then people would get a better, fairer advice. Because if they pay a fee for advice up front, irrespective of what the outcome is, then you are less likely to get somebody to be a bit more biased towards the idea that transferring is good for them. Okay, there are arguments that contingent charging does give people access to advice, because they might not be able to afford to pay the fee to have advice in the first place out of their own money. But I'm not sure I go down that line and think that's a great thing. And when the FCA did this review, it was I read the outcome of it. It was published in the last week, which is why I'm talking about it. And one of the lines in there is effectively that the people, authorised firms, were the ones who didn't like the ban. And so if you read about it and were going to be slightly cynical, the ones who could make the most money out of it weren't that keen on the ban, but they couldn't come up with basically a reason why or alternative that would work. And so the FCA is banning from the 1st of October 2020 contingent charging fees on defined benefit transfers, which obviously is good news. Now, getting to the crux of what I'm talking about is there are obviously a lot of people who have had a transfer and they may be sitting there thinking, actually, yeah, was it the best thing for me to do? And they may be sitting there in the light of what's going on in the market thinking, I didn't really quite get that this was going to happen. Now, this isn't about people not taking responsibility. This is about people receiving bad advice. And what the FCA have done is probably one of the first times I've seen it produce something useful that consumers can use. And they've produced a website page, which is, I'll give you the address, it's fca.org.uk/defined-benefit-transfers/advice-checker. As I said, go to the page on our website. You can click on that link. And what that page is quite a wordy page, but talks about advice that you could have received on a defined benefit transfer, but in particular gives you some pointers and a checklist almost to go through to determine whether you received bad advice and whether you have grounds for a complaint. So I'm literally going to read them off the site, and so people can hear, and it may be that it's relevant to them or somebody that they know.
Yeah, that's a good point, actually, because even if it's not relevant to you probably do know someone who's worked in those sectors that may benefit from it. So yeah, go for it.
So the site says, like I say, you can go to the link, you read it yourself, but here's some of the points to check to see if you receive poor defined benefit transfer advice. So they say if any of the following statements are true, you may be more likely to have received poor advice. So your advisor did not ask you for all of the following: information about you or your family, how much income you need to support your family during your retirement, information about you and, if relevant, your partner's employment, current income, spending, tax position, entitlement to state pension or benefits, information about your health or your partner's health if it's relevant, your spouse's other pensions or assets or debts, your priorities and spending plans for retirement, and how much risk you felt comfortable with and the extent to which you were prepared to accept a reduced lifestyle in retirement if investments performed poorly. Moving on from that, your advisor did not check your knowledge and understanding of defined benefit and defined contribution pension schemes and the risks and benefits. They didn't explain that so you could understand what you were giving up. Your advisor did not consider how you could achieve the retirement you wanted by keeping your defined benefit scheme. The pension you transferred was your only one or your largest guaranteed pension, and you had few other assets to support yourself in retirement apart from the state pension. Your advisor recommended you transfer and purchase a guaranteed lifetime income, an annuity, even though you were in an average or good health. Your advisor did not show how you could meet at least your essential income needs, such as paying bills and rent from your defined benefit scheme for your lifetime, because they focused on one or more of the following: giving you flexibility and control of your pension, maximising the death benefits payable in the event of your death, helping you achieve early retirement, helping you take a larger tax-free lump sum. So I'm not going to go through the rest of them. I've read quite a few out there, but it's one of the first times I've seen something that the FCA has done that's very useful, that is very explicit, and people can go there and go, right, look, there's a bit of a checklist here that I can go through, and perhaps I didn't get the advice that I thought. And so you may have grounds for complaint. Now, if you want to complain, of course, you have to go to the firm who gave you the advice first. They have to respond within 8 weeks with an answer or tell you they need a bit more time. At some point, you're going to get a final reply to your complaint. If you're not happy with that, you can obviously refer it to the Financial Ombudsman Service. So there's, again, all the information is there, the full checklist. Go through it, pass it on to anybody that you think may need it. This is not about people who have made a decision trying to get money back and trying to game the system. I know there's a lot of people out there, or not saying there's not a lot. I've seen people out there who make that kind of comment, but there are people who were given bad advice and they were perhaps targeted by advisors in an unsolicited way. So do go through that list. I think there'll be some people out there who perhaps could benefit from it. And also, it's good to see the FCA finally doing something direct, acting swiftly and producing something that consumers can use directly that is black and white, That's the difference. Something that is explicit, because they tend to very often be very woolly and hide behind sort of grey wording and give the opportunity for a multiple interpretations of what they're saying in the rules. So good on them, Andy.
Good on them indeed. And that moves us on to the last piece. It's a very small piece, obviously gone into detail on a couple of large meaty pieces there. It was my money week this week, and I just wanted to briefly touch on a couple of really cool apps that I've seen out there. I've been trying to teach my children over the past few weeks about the value of money. We moved into a new house, we've bought new things, and often, you know what children are like. They're inquisitive and they don't often understand the value of money. So we talked on the podcast a few weeks ago about resources you could do. Well, we've just started actually giving our children pocket money. Now, of course, we've been through lockdown. The children themselves haven't been able to get out and spend that money. So I was looking at other options on how my children could get to spend the money eventually when things get eased up. And there are a few pretty cool apps out there that allow your children to take charge of their money. And I just wanted to go through a few of them. So there's 4 apps I'm going to very, very quickly go through, and they are, I'll read them out so you can have a look at them in your own time. It's Go Henry, Osper, OSPER, Nimble, NIMBL, and Rooster Money. Now, essentially, these all do pretty much the same thing. There's nuances between them and slight price differences, but to summarize, what they do is they allow you as a parent to control an app. They will also get an app and see a different side of the app, and you can control their spending, but with an element of them feeling like they're able to do it themselves. So they can set savings goals. They can set an amount aside from their pocket money each week that they save long term. They'll get their own card. So your child will get their own card sent in the post, either Visa or MasterCard, depending on which app you choose. There's different options depending on which one. And the cost is generally between about £2.50 and £3 a month to get access to these services. And what that pays for is that pays for the money transfers that you're doing from your account to their account. It pays for the card itself to be sent in the post, and obviously the upkeep of the app. It's a pretty cool idea. It means children can have a bit more flexibility. They can understand and look at what's going on with their money. There's some cool games on some of them as well. And as a parent, you have a little bit of control as well, because you can actually set which retailers they can and can't spend. So there is an element of control there as well. So go and have a look at them. I mentioned the names earlier. I'll mention them quickly again. So they are Go Henry, Osper, Nimble, and Rooster Money. And just as a little throwaway bit at the end there, if you are interested in that but aren't interested in spending money on something, if you are a member of one of these new app-only banks like Monzo and Starling, they actually have a feature now where you can get an additional spending card. With Starling, it's called a connected card. I think Monzo do something similar, or they're planning to. You can actually apply to have that sent to you in the post, and effectively it's the same thing. You can control that card from your app and give it to your child, and they can go ahead and spend, and you can set which retailers get spent. The only difference is they don't get their own app to see where their money's being spent. So there's less interactivity from the child's perspective, but you can still, as a parent, let them have a card and go off and spend. But I tell you where that would be particularly useful, Damien, when children get back to school and you want to be able to give them the ability to buy their school lunches, or, I don't know, train fares, bus fares, that kind of thing. I think it works really well. So that's it. Go and have a look. There are some really cool pocket money apps out there. We're done. Damien, anything else?
No, good piece, Andy. I like that. No, that is it for this week. I don't think there's anything else. Like I say, do leave a review. Oh, one bit of exciting news. I know I mentioned it before, probably a year ago, but we are very, very close to launching the brand new Money to the Masses site. So if you are in our group, our Facebook community group, if not, why not? If you're in our group, then we are going to ask for volunteers for people to test it. So by that, I mean, when it goes live, nothing in the world, with the best will in the world, will ever be 100% right in terms of tech. You'll always be a little glitch somewhere. And of course, we'll iron them all out before launch, we hope to, but there'll always be something. So what we want is other people to basically have a play around on the site. So do listen out or look out for that in the Facebook community group, because you can help us help you.
Brilliant. So if you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. We're also on Instagram. There's some really cool infographics gone out this week. Go and have a look at those. And of course, please do review us and check out the stuff we're doing on YouTube. That's it. We're done. Until next time.
Until next time.